Thought Leadership from PwC's National Office Studios.
Welcome to PwC's Accounting Podcast. I'm Heather Horn. Thanks for tuning in to the next episode in our Full Disclosure Summer Series, a show all about presentation and disclosure from the top of the financial statements down to the last footnote. While it may sound like Accounting 101, I've learned something new every episode. Today's focus, income taxes.
Honestly, I think I'd probably say that there's a lot of focus right now globally on tax transparency. So I'd encourage companies to look at the disclosure requirements that we've talked about as a minimum. Push yourself a little bit to be more transparent so that your regulator or your investors or any other stakeholders can actually understand why your tax costs and benefits look the way they do.
That's my guest, Cassie Bauman, a managing director in PwC's national office and one of our leading experts on income tax accounting. For a lot of accountants, even if they, quote, get the accounting, there are still many specific disclosures and lots of specific presentations. That's why I'm excited to devote a full episode dedicated to the presentation and disclosure of income taxes. So Cassie, thanks so much for joining me today to talk about income tax presentation and disclosure. And I was just saying before we got started that we actually have 7 podcasts on income taxes, but this will be the first one really focused on this topic. So very glad to have you on as always. But if we're talking about income tax presentation and disclosure, where's the best place to start?
Yep, let's dive in. There is a long list. So I think from an income tax perspective, it makes sense to divide the financial statement presentation and disclosure into 4 separate buckets. The first would be balance sheet related items, and then income statement related items. Disclosures related to uncertain tax positions would be the third bucket. And then the fourth is kind of an other, things that are income tax related but don't really fit neatly into one of the first 3 buckets. During our podcast today, we're going to hit on 3 of those 4 topics. However, we're going to skip the disclosures related to uncertain tax positions because we had many moons ago taped a separate video that's available on Viewpoint that's specific to that topic.
Perfect. We'll make sure that we have a link to that video in the show notes so people can find it. But Cassie, why don't we get started with the balance sheet presentation? And I like the fact you made these categories because I do think for a lot of accountants, not tax accountants, but non-tax accountants, they know maybe the basic rules for income taxes, but not the disclosures. So I do think having these categories can help people in their own minds kind of organize it. So again, starting with balance sheet, how should you present income taxes?
Sure. So when you're looking at a balance sheet, I would probably expect to see a few different line items related to income taxes, if it's a tax-paying entity, obviously. So first, you're likely to see a line item for income taxes payable or income taxes receivable. That could be current or non-current. And you could see more than one, honestly, depending on how material it is, because you may have a payable in one jurisdiction and a receivable in another. So that's the first thing you're likely to see. The second thing you're likely to see is deferred tax assets and liabilities, net of any related valuation allowance. And so deferred taxes are required to be classified as non-current. So you should only see them in the non-current section. And that's if a company presents a classified balance sheet. And then the third thing that you may see is a line item for uncertain tax position liabilities. And that could also be current or non-current or both. And for UTP liabilities, it's not a required breakout on the balance sheet. So if it's not a material number, you could aggregate it with something else. Often people may group it in the other non-current liabilities line. But one thing is clear in the guidance is that you can't group it in with deferred tax assets and liabilities.
All right, that's helpful. So I think the key point there, just to reiterate, because I think instinctively many people may want to group all their tax things, is that you really have to look at these separate accounts and make sure they're classified appropriately. And grouped or not grouped, as you said. A couple of questions though. So you didn't mention interest. So if you have interest on your receivables or payables, do they just get included in that same line?
Yes.
Okay, perfect. And then you also mentioned not netting when you have multiple jurisdictions, but how should companies be thinking overall about when they have multiple jurisdictions? Are there any other considerations?
Yeah, so the whole of ASC 740, the income tax guidance, is kind of a jurisdictional approach. And so this comes up most often. It's most significant when you're thinking about deferred tax assets and liabilities within a jurisdiction, meaning you can only net deferred tax assets and deferred tax liabilities in a single jurisdiction. You can't offset deferred tax liabilities in one jurisdiction against deferred tax assets from another jurisdiction.
Okay. Is it fair to say that that same rule applies to payables and receivables? So you also should not be netting those across jurisdictions?
It does, although that's not specific in 740. That really comes, I think, from the netting guidance that's in ASC 210. But realistically, I think a lot of times by the time companies get to the end of the year, they may not have significant payables and receivables that they would break out.
All right. That's helpful. And I think definitely good background to understand how you can wind up with so many tax related line items on the balance sheet, because I do think sometimes there's questions about that. So then if we're thinking about disclosure related to income taxes on the balance sheet, what are the key requirements?
Let me start with all of the disclosures related to deferred tax assets and liabilities, since that's what we were just talking about. So companies are required to disclose total deferred tax assets for the company and total deferred tax liabilities for the company for each period that a balance sheet is presented. And a public company has to also disclose the approximate tax effect of each type of significant deferred tax asset and liability. And that would be before any valuation allowance is recorded. So this would be a gross disclosure, gross of a valuation allowance. Now, in relation to DTAs that you might have for NOLs or tax credit carry forwards, the company is required to disclose the related amounts of those carry forwards and any expiration dates that are associated with them. And although the standard specifically says NOLs and credit carry forwards, I think it's safe to say companies should apply that to any carry forward. So commonly today, a lot of companies have interest limitation carry forwards. And although I guess technically that doesn't fit into the words NOL or credit carry forward, it's a carry forward that we would encourage them to also disclose in this vein. And these disclosures should be presented on the same basis as those items are presented on the balance sheet, meaning they're tax affected and they're net of any unrecognized tax benefits that they might have for any uncertain tax position. And then the other item that companies should disclose is any current or potential limitations on the utilization of those losses or tax credit carry forwards. So, for example, there's some limitations in the tax law, depending on what country you're talking about, that could deal with a potential change in ownership or an IPO that might limit a company's ability to utilize NOLs, for example. And so if those things exist, they should be disclosed so that a reader would know that there's a limitation, even though you might have all these NOLs sitting there.
All right. And then Cassie, something like when we recently had tax reform, then that would have obviously impacted all these disclosures because it changed the timing of some of those, or to your point, added that interest limitation.
That's right. Yep.
Okay. All right. And then another question for you. You used the word significant when you were talking about your DTAs and your DTLs. And I think, again, as accountants, we always like to know if there's bright lines there, or really what do we mean when we say significant? So is there a framework of how companies should be thinking about that?
In this case, there actually isn't a bright line. So when you're thinking about that deferred tax asset and liability footnote, you basically need to determine for your particular company what is significant. I think most companies tend to do that using a quantitative threshold. It could be qualitative technically, but it's really kind of a judgmental area that companies can interpret what significant might mean to them.
All right. So it sounds like each company should think about it. Although I do know from my own experience that this is a good place where it's important to have a policy. So, sort of from period to period, and you definitely don't want to have too much that ends up in the sort of other, or you're going to want to break some more out. So a couple things to think about there. And then Cassie, another point here, you made the comments a couple times, this is just for public companies. And so this I know doesn't apply to private companies, but can you just give us a little background on that?
Yeah, so specific to this quantitative chart of deferred tax assets and liabilities, private companies don't have to break that out. It doesn't have to be quantitative. However, they are required to disclose qualitative information about the nature of the significant items in there. And so you'll usually just see, in a paragraph form without the numbers is generally the difference between a public company and a private.
All right. That's helpful. And then you also mentioned temporary differences and carry forwards. We didn't say anything specifically about allowances. So any specific disclosures required when you do have a valuation allowance?
There are. And moving into the next category of disclosures, companies do need to disclose the total valuation allowance. So that would be total company and the net change in a valuation allowance for each period that a balance sheet is presented. And if a company is relying, there's 4 sources of income for realizing deferred tax assets. And if a company is relying on a forecast of taxable income, which is one of those 4 sources, it's generally a really good idea to disclose the extent to which realization is dependent on a forecast. It's the wording in the standard is a little bit soft, but it is an area that the SEC is often kind of focused on.
And Cassie, maybe I want to ask about the SEC, but before I do, is this specific only to that source, or do you normally see companies, disclosing any of those 4 kind of sources of reliance?
The other one that companies will often disclose is tax planning strategies. And that's really, I think it's because tax planning strategies and forecasts of taxable income are 2 of the more subjective sources of income compared to the other 2, which are just reversing DTLs and carryback. So if the valuation allowance or the impact of that tax planning strategy not occurring or the forecast not coming through like expected would be material, that's really when companies, should consider being transparent about the nature of what they're relying on in order to not have a valuation allowance or to have a smaller VA than they would need otherwise.
All right. And then I know you must mention the SEC staff. So what kind of questions do we get or do you see typically from the SEC staff when they're looking at these VA disclosures?
Yeah, so this is a common area of comment from the SEC staff. And the 2 buckets I would say they typically comment on are first asking for more information about what positive and negative evidence the company relied on in order to determine their valuation allowance conclusion. Sometimes they're asking because they want to know, but they don't require additional disclosure, but sometimes they do. And I think that that can hinge on, how critical that information is to a material conclusion around a VA. And then the second thing that the SEC staff also is looking for is early warning disclosure. So if you expect to either have a valuation allowance release or you're pretty close to meeting a valuation allowance, like if things don't kind of pan out the way you hoped, then the SEC expects you to have early warning disclosure the quarter before or 2 quarters before, whatever whatever period makes sense. So, a lot of times companies will get comments when they all of a sudden release a valuation allowance and there was no early warning. If there's not something obvious that happened in a quarter to trigger that valuation allowance, then the SEC will often ask questions about that.
All right. And then one point of clarity here, since we were earlier talking about a disclosure that wasn't required for private companies, and now we're talking about the SEC, just to clarify, are these valuation allowance disclosures required for both public and private or only public?
They are required for both public and private.
All right, good. I just didn't want our private company listeners to miss out on that. And then another question for you on the balance sheet is, when we're talking about balance sheet disclosures of taxes, it sounds like most of them really relate to the deferred tax assets and liabilities.
Yeah, that is true. There are a fair number related to uncertain tax position disclosures, but since we're not covering them today, we can skip those. So the only other area, which is still deferred related, but it's for deferreds that are not recognized on your balance sheet, is that if listeners have heard some of our other podcasts, they may be familiar with the concept of outside basis differences, which is the difference between the book basis and tax basis in a subsidiary. And there are exceptions in 740 that would say, if you have a deferred tax, if you would have a deferred tax liability, so your book basis was higher than your tax basis, say in a foreign subsidiary, and you're indefinitely reinvested, you assert that you're indefinitely reinvested in that subsidiary, that you don't have to record the deferred tax liability that would have arisen or would have to be recorded otherwise if you were going to bring back the earnings, say. And so if you do have unrecognized deferred tax liabilities related to subsidiaries or joint ventures, there is a bullet point list of things that you have to disclose related to that. And the first item is just a description of the types of temporary differences and the types of events that would cause those differences to become taxable. You'd also have to disclose the cumulative amount of each type of temporary difference. And then finally, you have to estimate the amount of unrecognized deferred tax liability that you did not record for those foreign subsidiaries and foreign joint ventures. If you can determine that amount, the standard does allow for, if that determining that unrecognized deferred tax liability is impracticable, that you can disclose that it's impracticable. So this is something that, companies, I think, historically, many companies have disclosed that it is impracticable, but it's something to continue to push on. As tax law has evolved over time, it doesn't necessarily, it may become more or less complicated to come up with that number. And so, I encourage companies to just think about each period that they say it's impracticable, whether it really is.
All right. That's always a good reminder. And I think in particular, some more complex disclosures in that area. So we'll at the end get to where people can go look if they want to read these rules someplace with a little interpretation. But before that, let's move on to the income statement. And so just let's start with the basics. How would you present income taxes on the income statement?
Yeah, so presentation and disclosure blur a little bit here. Obviously, there's an income tax line that I think everyone is aware of. It comes between pre-tax income and net income. But companies here are required to disclose the amount of income tax expense or benefit that's allocated to continuing operations. So that's usually what you're seeing on the financial statements when you're looking at the income statement. The companies also have to disclose the amounts allocated to other categories of income, like discontinued operations or OCI. And again, here, you're often seeing these disclosures. I think sometimes you hear disclosure and you think footnote, but you can disclose it anywhere, right? You can do it right on the face of the financials. And this is an area where I think companies typically do that. So for example, if you had discontinued operations, a lot of times you'll see a line item that says like income from discontinued operations, net of tax of X dollars. Or on the statement of other comprehensive income, you might see the various line items that comprise your OCI, and they'll have tax effects. So it might say like cumulative translation adjustment, net of tax of Y dollars.
Right. And I know from my own experience, when you have those parenthetical disclosures, it sometimes feels easy to skip over them when you're preparing and tying out the financial statements. And that is definitely not something you want to be scrambling at the end with just leaving an X and planning to fill it in at the last minute. So that's, again, just a quick reminder there. But Cassie, then let's go back to the sort of broad one line item that's named income tax expense, because obviously there's could be many, many components in there. So what are the disclosures that companies should keep in mind?
Yeah, so here both public and private companies are required to disclose the significant components of income tax expense that are attributable to continuing operations. So the standard actually does have a list of common significant components. I'm not going to go through all of them here, but some of the more common ones that you would expect to see are things like current tax expense, deferred tax expense, any benefits of any operating loss carry forwards, any adjustments that are resulting from, say, enacted tax laws or a change in tax rate. And then if companies have investment tax credits, that's another area that they're supposed to disclose. So again, that's not the whole list, but there are some more in 740. But the thing to remember is the sum of all those things should equal that line item on your income statement that says, income tax expense related to continuing operations.
Cassie, one question, actually, you mentioned ITCs. We didn't talk about ITCs with the balance sheet. Do companies normally have to break that out on the balance sheet, or are those grouped with other line items?
They're usually grouped. So if they carried them forward, they would be just part of your deferred tax assets. But if you actually use them in the year that they were granted, if you use the deferral method, they would have just been netted into the asset, like the PP&E or whatever they related to. But there's only really one method where they would show up, which is the deferred credit method.
All right. So Cassie, let me go back then to the components that you just described in terms of what you need to disclose related to your income statement, income tax. And all of those components seem to relate to the effective tax rate and the effective tax rate reconciliation. But I know this is a place where there's different requirements for public and private companies. So can you walk through that?
Yeah, sure. So public companies are required to provide a numeric tax rate reconciliation. Private companies don't have that same requirement. They can just kind of describe in words the nature of significant reconciling items. That's the key difference between the two.
All right, got it. And then can you just give us some additional details for the companies that are required to disclose the ETR, what needs to be disclosed?
Sure thing. So the ETR reconciles that income tax expense attributable to continuing operations, that line item from the P&L, to the statutory federal income tax rate applied to your pre-tax. So if you think about, if I took my pre-tax income and I multiplied it by the US tax rate, what would my tax expense be? And then what is it? And I have to reconcile the difference between the two. You can do this, or a company can do this either in numbers or they can do it in percentages. And if they don't use the US federal as their corporate tax rate, that's not the rate that they're starting from, then they also have to disclose the rate that they're using and the basis for using that rate.
All right. And then in terms of the other components, how much detail do you normally see companies including in terms of the reconciling items?
So here, there is actually guidance. So I know you were asking about a threshold before. There is a threshold here, and that's from the SEC guidance. So Regulation SX, it's section 4-08H, actually provides that you have to break out line items that are more than 5% of the amount that's computed by multiplying pre-tax by the statutory rate. So if you were doing that in a percentage fashion, if your rate rec was a percentage, it would be anything that's over, and you're using the US rate, then it would be anything over like 1.05% would have to be broken out. And the key thing here is to be conscious of not aggregating or disaggregating in order to avoid this 5% threshold. And only aggregating things that actually seem to go together, unless you're doing like an other line that would still be below that threshold. The other thing here is to think about consistency from period to period to the extent that it makes sense, right? I mean, you might have an item that is in one year and not another, and that's just reality. But, if you have, say, your foreign rate differential is a common line item, you wouldn't want to be putting that in its own line item in one year and then aggregating it with something else in a different year, because it really hides the transparency from year to year for your users.
And then, Cassie, you mentioned that this could be a percentage or a dollar. I feel like from my experience, I normally see dollar amounts, but is there a trend there or is it really company specific?
It seems to really be company specific. But it does seem, I don't know if it's like an own personal choice type thing, because once you pick it, companies tend to stick with what they have been doing.
All right. And then I know you said that the rules for this or the breakout rules come from an SEC rule. And so is this another place where we see a lot of comments or trends in terms of coming from the SEC on these disclosures particularly?
Yeah, it actually is. It's one of the other kind of top two areas for SEC comment letters. So an example of a comment you might get from the SEC in this area is, we note that the line item in your change in U.S. tax status of foreign entities in your tax rate reconciliation, please tell us what that is and revise it to describe the nature of that reconciling item. So sometimes, for example, that description just might not be clear, especially if that's the only place you see it. If you had some significant event that's impacting your rate, but say it didn't impact anything else, so you didn't talk about it in your MD&A, you didn't have another footnote that talks about it, then the words that are in the rate rec might be the only place that it's really transparent that something happened. And in that case, you either have to be really crisp on the words or you should provide some explanation about what it is.
All right. That's helpful. And then anything else from an income statement perspective that you would recommend our listeners focus on?
Yeah, there's 3 additional items. So we talked a little bit about investment tax credits, but if you have an investment tax credit, you're required to disclose the method of accounting that you use. So there's 2 acceptable methods, the deferral method or the flow-through method. That is a policy choice, so it should be consistent from period to period. The second item that I'll mention is that companies have to identify the components of income or loss before tax expense as either foreign or domestic. This is a public company only requirement, but you have to break out your tax expense between foreign and domestic. And the third item that companies have to disclose relates to tax holidays that the company may have been granted for some specific period from a particular tax jurisdiction. So the disclosure here should include the aggregate dollar amount of the tax holiday and the per share effect of the tax holiday, and also briefly describe any facts and circumstances related to the tax holiday, including when it's supposed to terminate. And this is an SEC, you might have guessed from the per share reference, this is an SEC disclosure. And so private companies don't have this requirement, although I have seen, if it's pretty significant, I've seen some private companies disclose this.
All right, that's helpful. And so then, Cassie, we covered balance sheet, presentation and disclosure, and income statement presentation and disclosure. But you mentioned other, which I always find intriguing. So can you walk us through any important of these other requirements?
Yeah, there's a few that could fall into here, but a lot of them aren't very pervasive. So I'm just really going to focus on the one that is. And that is significant income tax risks and uncertainties disclosures. So this is actually not 740 related, the income tax standard. This is guidance under a different set of ASC standards, which is 275. And that requirement says that in both your annual and interim financial statements, you have to disclose any risks and uncertainties related to key information. And so the disclosures under that concept are equally applicable to income tax matters, such as valuation allowances or indefinite reversal assertions for unremitted earnings. So when it's at least reasonably possible that a material adjustment will occur to those estimates, those income tax related estimates, in the near term, the financial statements should disclose the potential uncertainty along with a range of impact.
All right. So then last question for you, Cassie, is I know there's been an ongoing standard setting project related to income tax disclosures. So can you give us the latest on that project?
Sure. So our listeners might be aware that the FASB has had this project for a few years now. The last proposal that was exposed for comment was back in 2019. And that basically the proposals here codify some of the SEC requirements into 740, so they wouldn't have a lot of changes. There are some proposed additional disclosures in that last exposure draft. And there's also proposed removal of 2 existing disclosures. However, there really hasn't been a whole lot of movement since 2019. And then since then, there's been some turnover at the FASB in the form of some board members whose terms were up, and now there are some new board members, as well as some political changes, obviously a change in administration, as well as some tax reform that is, likely on the way later in 2021. So all of that could potentially impact the direction that the project goes, what's required, changes that might be made. So I'd really just encourage companies to monitor the status of that project, as it could have, a variety of implications on your income tax disclosures.
All right. Thank you. And then Cassie, just to wrap things up, I mentioned at the beginning that we actually have had 7 income tax podcasts prior to this one. And I was just checking my handy data, and I noticed the most popular one was the valuation allowance on deferred tax assets, that the basics that we did back in December 2019. But from your perspective, any personal favorites or any ones that you would really recommend from a listener perspective if they were trying to understand some important income tax concepts?
I would say the Outside Basis podcast, because I just think there's still a lot of people who don't intuitively grasp what the difference is between an outside basis difference and an inside basis difference. And I felt like that podcast did a good job of kind of capturing the basics of that and distinguishing between the two, to just try to help people who aren't embedded in tax every day to try to understand the difference.
Yes. And I can say from my own perspective, that is a concept I have struggled with, and it did help me a lot. So I would agree. I think that's a great recommendation. So Cassie, it's always such a pleasure to have you on, and thanks so much for all your insight.
Thanks, Heather.
To listen to Cassie's favorite tax podcast, along with any of the others from our tax podcast library, head over to wherever you listen to your podcasts. While there, be sure to follow PwC's accounting podcast so you never miss an episode. We release new episodes every Tuesday and Thursday. To stay up to date on all the latest content, subscribe to our newsletter at viewpoint.pwc.com, and let's connect on LinkedIn. For PwC's National Office Studios, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.